Intel, ticker INTC, announced on Wednesday that they will be cutting their dividend by 65%, from 36 cents per share to 12 cents per share. This is a massive cut to Intel shareholders, but at the same time, it was expected. Dividend cuts are the dividend investor's worst nightmare, because depending on what part you are on your financial journey, it could literally knock off a huge portion of your retirement income. Now, Intel has been paying a growing dividend for decades, and for the past 10 years, it has been growing a little under 5%, which is above the average inflation. So let's dive into what led Intel to take this decision and what factors you can check to avoid this. Intel is in an industry where the competition is extremely high, and they had consistent amount of difficult quarters where they kept losing market share to its rival AMD. In the past, Apple decided to create their own processor, ditching their partnership with Intel, which also added downward pressure on the revenues from the company. Also, we are living in a post-COVID era where demands for certain products has diminished compared to the peak of the pandemic. This has also weighted down Intel in their sales in PC market and data center segments. When we take a look at the fundamentals over the past 5 years, Intel is down 47%. Intel belongs to a capital-intensive industry where capital expenditure and research and development is high to maintain the operation running, and to stay ahead of the competition while attempting to expand the mode of the business. In order to cover the sustainability and growth of the company, capital is needed. This is where the free cash flow comes in. So before the pandemic, Intel's free cash flow was somewhat flat. Afterwards, demand was needed for their products, so their revenue and net income increased. Therefore, the free cash flow increased as well. But as mentioned before, post-pandemic, the demand went down. Also, remember that throughout all the time, Intel was losing market share to competitors and contracts. Also, something that we tend to ignore is stock-based compensation, which means paying with stocks instead of cash. This also takes a negative impact on the cash flows of the company, and as shown in the graph, Intel's compensation is growing. So with all those factors into consideration, which is declining and negative free cash flow, stock-based compensation, declining revenue, and losing market share, therefore not having a strong moat, it has led to the management of Intel to cut the dividend in order to reallocate the cash into the company, invest more internally, and regain the terrain that they have lost within the industry. So right now, this is very bad for the shareholders, but long term, it could be a good play for sustainability and growth of the business. When we have a company currently paying a dividend, there are some factors to consider so we can understand how healthy and sustainable the dividend is. Now, I listed 4 key points that I usually research to figure out how the business is doing, because a healthy business will reflect in a healthy dividend being paid. The first one will be a strong, durable moat. This is that despite competitors, your product or services are preferred over others. This could include branding, quality, and sustainability. It's having an advantage over your competitors even if they sell the quote-unquote same product as you. Number 2, increasing earnings. The faster and compounded earnings grow, the better. This allows you to unlock the possibility of moat expenditure and invest more for growth. Number 3, growing free cash flow. When you have increasing income while reducing your expenses, your free cash flow will grow. With this, you can pay a healthy and strong dividend long term, while expanding the business and also have leftover cash for rainy days. And number 4, return on capital employed. This measures the profitability of a company and the efficiency with which it uses its capital, which means that if a company uses its free money to make more money efficiently, it will compound into higher returns long term. So those are the key points I look in for a healthy long-term growing dividend within a business. It's very important to be up to date with the fundamentals of a business and keep an eye on the earnings from time to time for any red flag that appears. That will be it for today's video. Thanks for watching. Till next time.